All right. Hey there. What's going on, everybody? Let me see if I can, there we go. Chris Franks with Texas West Capital coming at you live here just after 11 a.m. Central Standard Time here on, what is today? Today is Friday, the 6th of September, 2024. Hopefully you guys are doing all right out there. Let me get the comments up over so I see what you guys are doing. Yeah, so we have some things going on, right? We had the NFP come out today, and then we have, of course, the Fed rate decision coming up in just under 2 weeks. So I figure we focus on that a little bit today and look at some charts as well. Numbers, payrolls today. Payrolls came out. They were expected to be 160,000. They came out at 142,000. Not terribly off, but still soft nonetheless. But it is a rise from the previous month's 114,000 jobs. Now, that said, there actually was a revisions over the last over June and July with their numbers coming in. Let me see my notes here. June numbers were revised downward by 61,000 from 179,000 to 118,000. July's job numbers were revised downward by 25,000, taking it from 114,000 to 89,000. So effectively, we've had job growth. We had jobs go down June and July, and then up above June's numbers in August. Now, obviously, that's until the next revision, right? But as my friend Joe Calasari likes to say, when it comes to the government's jobs numbers, garbage in, garbage out, right? Just the methodology in which they do it is not very conducive to accuracy. And that's why they have, the monthly revisions, yearly revisions, all that kind of stuff. But the thing is, people are going to trade on those numbers. So whether they're correct or not, people are going to trade on them. And that's the important thing. When I post, these numbers, when they get released there on Twitter, on X, a lot of times I'll get, feedback. I'll get a little pushback from people because oh, its numbers are all fake, or they're so bad and whatever. But that's not the point, right? The point is that people trade the numbers. That's the point. Now if you want to argue about whether we're headed to recession or not or whatever, okay, well then you probably don't want to watch those particular numbers. Though if we're looking at, the definitions of recession that we've used historically, we're going to have to we're going to have to use the numbers that come out with the economic indicators that the Fed uses, right? So, we can sit here and you can argue about, about how terrible the numbers are, they're not real and all this, and they're always being revised and all that. But at the end of the day, so what? I have to say that. I have to say, so what? Because if you're in the market, that's what people are trading on. That's what the algos are trading on. That's what the sentiment indicators are, reading when they kind of, look for the sentiment. And so, when you get in there, you have to separate your personal beliefs and your personal thoughts about things with what's actually being, thrown out there, because what's being thrown out there is what, if you're in the market, is what other market participants are actually trading on. Okay. Or buying, investing on, stuff like that. So it's not saying that you're wrong or that there's anything wrong with you understanding that it's probably garbage in, garbage out with, for instance, jobs numbers from the BLS. But at the same time, again, you have to figure out, well, what am I doing here? Am I just trying to say that it's a bunch of nonsense the way numbers come out, or I'm actually trying to make money, right? And if you're in the market, you're trying to make money, right? So, I think that's a big hindrance that a lot of people have, is they've got this push that they have to, whatever their feelings or beliefs are, have to be acknowledged, and they have to be held up to some, pushed up into the sky and just worshipped and whatever. And at the end of the day, none of that really matters when it actually comes to making money. All right. So, when we're looking at that, that's what we're kind of looking at. So again, numbers today, even though they came in, under the 160,000, they came in greater than the revised numbers from June and July. By the way, that July number at 89,000, I believe that was the lowest job rate increase numbers since the pandemic began back in 2020. So a significantly lower number there, but nonetheless, overall, unemployment, by the way, dropped from 4.3 to 4.2%. Now, again, historically, I keep trying to push this so you guys understand, that y'all are getting freaked out about a move from 4% to 4.3% last month. And of course, now that's moved down to 4.2%. You're freaking out about that. But the reality is that on average, historically, 5% has been considered full employment. It's not a big deal, folks. We stayed below 4%, I think, for probably a record time. If not, it was pretty close to it. I remember looking back, there may have been one period where it was actually longer than that. Not by a whole lot, but it was longer than that. I mean, you're talking about historic. There's a lot of things that are happening right now. Again, the unemployment staying below 4% for a historic, length of time. The yield curve remaining uninverted for a historic length of time. When these things come up, the base thing, it's social media, right? So this is the same thing I try to explain to traders. There's a lot of free information on how to trade out there online. Most of it is half truths and outright lies. Most of it is going to lose your money, but it's the same old regurgitated base level nonsense that's been put out there for decades. Okay. And it'll end up hurting you more than it'll help you. Same thing when it comes to these things like, the Fed rate cut means we're going to go into recession, or unemployment going up a little bit means we're going to a recession, or uninverted yield curve, or inverting yield curve, uninverting, or these things happen at the same time means that, right? Historically, for the most part, that's been kind of correct, but you're talking about just the thing happening, right? You're not understanding what's going on below the hood, so to speak. And so there is a lot of things that are different right now with why things are happening. Now, that doesn't mean we can't get a recession. And I want to make this clear, because a lot of people, a lot of times people go, oh, well, you said we're definitely not getting a recession. No, I've never said we're definitely not doing something. What I said is, right now, with the way things are, with the way the numbers are, with the way that things are unfolding, with the reasons for why they're unfolding, it seems less likely than more likely. Okay. And what does that mean? That means, we can be prepared for a potential recession, but until the stuff actually happens, you're going to be losing money trading against the trend, right? Think about people for the past 2 years. For the past 2 years, there have been a group of people that have consistently, every day, every week, every month, every year for the last 2 years, been promising you that a recession was coming in because of this, because of that. But we haven't, right? They've tried shorting consistently every time they think there's a top in there, right? And they end up losing money because it can go back against them and makes a new all-time high, right? But not only are they losing money trying to short the trend, right, that hasn't reversed yet, but they're also missing the opportunity cost, right? The fact that they could be making money on the long side rather than trying to short it every time, it kind of comes up. So, I tell you all this just to get you to think beyond the little words that are, the little short clips that are being spread out there about things that have always, that they are always consistently saying, right? Again, the biggest thing to look at is, if we look at why does the Fed want to cut rates? Well, you go, okay, well, previously when the Fed cuts rates with the inverted yield curve, whatever, a recession is here. Well, okay. But previously when they're doing it, it's to get people out there to spend. It's to get people out there to do the opposite of what they're doing, right? Because there's like, again, they've entered a recession or something, right? And so people are not spending. They're not doing this. Credit's not being given out. So the Fed's cutting rates so that it can spur that movement, right? It can get people to start doing that. This time, the Fed's not cutting rates to do that. The Fed's cutting rates to normalize it. Now, whether they should have cut back in, this summer or, prior to now or whatever, that's up for debate. But nonetheless, they're not doing it as a response to people, just kind of hoarding, sitting on their butts, not spending money, all this kind of stuff, right? They're doing it to normalize what they've already done, which was that, by the way, the record rise in time and amount of Fed rate hikes that we had there, right? That was another, historical record thing that we did during the last few years. So when you look at it, it's not so important that a thing's happening as it is understanding why is that thing happening. Does that make sense? You need to be focused on trying to figure out, well, why is that thing happening rather than it does? Because here's the thing. Nothing is guaranteed in the markets. Absolutely nothing. No indicator is guaranteed. Economic or technical analysis or anything like that, right? Indicators are not guaranteed. So if we come in with that thought, then we go, okay, well, that means that things could be different this time around. Why could it be different? Well, corporations aren't looking too bad. They still look like they got some pretty good money, right? People's savings, while they're down from the pandemic high, are still pretty decent overall, right? We do have credit card debt going up. Well, we always have credit card debt going up, right? So when we look at these things, we go, okay, well, maybe what's going on here is not what normally we get when these things are happening. Okay? Does that make sense? So trying to dig in there a little bit more and understand the why that it's happening rather than just the fact that, blindly following that it is happening, I think ends up setting you up a lot better. So that's what we're doing. We're watching it, right? We're coming in. And so if we look at this, speaking of Fed rate cuts coming up, let me pull it up here real quick. Oh my gosh. I thought I already had this shared here. Give me just a minute, y'all. All right, let's pull this up here now. All right, so this is the Fed Watch tool, right? Yes, the 18th is going to be when the Fed announces their, what they're going to do, their policy decision, right? But this is now what we're looking at. So the markets are betting on a 47% chance that we get a 50 basis point rate cut, and a 53% chance that we just get a 25 basis point rate cut. Now, I still think we get 25%. I don't think anything's happened here that says, oh my God, we need to freak out and get 50%. Now, what does that mean for the markets? Well, here's the thing. A 25 basis point rate cut, right? That signals more of a relaxed kind of movement in the other direction, right? It says, okay, we're going to ease. We're going to ease into rate cuts. Why is that important? Because if the Fed is easing into rate cuts, it signals that they're not overly concerned that there's an issue out there. They think that, hey, we're still more likely than not to get a soft landing. A 50 basis point rate cut, then I think would probably freak people out a bit more because it's more of it's not just an easing, it's a sudden jump up, right? In that rate cut. And if we got that, I think, initially we might see, we might see Bitcoin kind of rally a bit. But I think ultimately we'd probably see a lower low. So, we'll look at the chart here in a minute, but we'd probably see maybe a move down toward those low 40s, right? Toward 43,000, which just gives us a 50% pullback of the third wave, right? Again, we'll show that there in a minute. So when we're looking at that though, is that a screenshot, Chris? The website now shows 23 chance for a 50%. No, I just loaded this. Let me try it again. Maybe it updated since I last loaded it here. Oh yeah, there we go. Yeah, that looks a lot better. You see how quickly this stuff changes? Troy, thank you so much for mentioning that, bud. Yeah, you see how quick this stuff changes, right? Because I had just loaded that up right there before we started the show here. So about 20 minutes ago. And this is the change since then. So now 23% chance of a 50 basis point rate cut, and then a 77% chance of a 25 basis point rate cut. Again, 25, is what we expect. It's what I've been expecting. It's what I've been talking to you guys about for months now. There's just no reason that I see for the Fed to actually jump up to a 50%. Now, you can maybe make the case that they should do a 50% if you believe they should have done 25% back in the summer. Okay, back in, what was it, July? But I think even then you're pushing it, right? Again, the whole idea of the rate cut right now is about normalization versus there's something wrong with the economy and they're trying to get people to act in the other direction, right? This is what we're talking about. This is the importance of understanding, well, what's going on. It's not enough that something happens. You have to understand, why is it happening? Or potentially, why it's happening, because that can give you a completely different outlook on what you expect to be the result. Now, we know historically September in stocks and crypto is a pretty poor month, right? I know for Bitcoin, 4 years out of all the last 14 years or whatever, only 4 years has September been positive month. So seasonality says we should have a crappy month, or at least a down month. And we could see it again. If I would think if we hit if we get a 50 basis point rate hike, that's likely to give us a dip down below that 49,000 low. My next target down there is right there around that 43,000 area, 42,825 or so. So, I would be looking for that. But in terms of the count, which we'll look at, it's still a wave 4. It's still, it's just a secondary target that we usually have for a wave 4. Here's the thing, though. Right now, here's the fear and greed index, right? And depending whichever one you look at, they might be different. But we've got 22 extreme fear right now, okay? Here's the thing. Markets don't top out on extreme greed, okay? They usually bottom, or extreme fear, I'm sorry. They usually bottom on that. Because why? We know, what does retail generally do? Retail generally buys the tops, right? They're exuberant, right? Their exuberance is irrational. It's huge. It's going, right? They're overly excited. It can't ever go down, right? They tend to sell the bottoms, though, because they're of the thought at that time that, oh my God, it's never going to go back up. It's got to keep going down, right? That's what we're looking at. So now we see, okay, well, we've got the fear and greed indicator here saying we're at extreme fear. It doesn't mean we have to bounce today, but oh my God, things start looking interesting, right? So let's start talking about that. Let me throw up, let me get my charts up here now for you guys, and we'll show you what I'm looking at here, okay? Let me see here. I think it's what we're looking at. Here we go. Let's get that up there. All righty, right. Now, here's Bitcoin, right? And Bitcoin, let's kind of get this bigger here. It has just pulled back. It's going to the 70.5%. Now, those of you that follow me, you know that my favorite retracement level is 70.5, right? That's the institutional pullback level. It's basically the halfway point between the 61.8 and the 78.6. Okay. This big green area that we're hitting here is demand. It's what we call demand structure. It's actually down in this wick this time. It's not always in a wick, or it's usually in a wick. Always in a wick. Sometimes other places as well. There we go. Well, a wick at the bottom, right? If it's at the top, it's actually a supply structure. But we're getting this dip in here. We're right around that hourly S1 pivot, right? We haven't quite reached the 70.5. Almost reached it there. So we can see this still coming. 78.6 is at 52,301.5. And hell, even the daily S1 pivot is down here. Now, that would be a deep pullback. It would, but, we've fallen below the pivot. We could see a pull down to there at around 50,000, about 50,300, and maybe get a rally up off that, right? Here's what we're looking for right now. We're looking for a rally and breakout, impulsive breakout and close on the daily above that daily pivot right there around 57,940 or so. If we can get that, if we can get impulsive breakout and close, that means decent candle spread, spike of volume, and close above it. Most often that indicates that the low is in. So that's the first thing we're going to look for, right? Based on the count here, though, A, B working on C, potentially here, we would need a break. I'm kind of torn here. I'm looking at right now, right up here at 61,202 on this chart. But also, it could potentially be a WXY, maybe right around here at 59,844.5. But really, so, if we can start breaking above those, that's going to indicate the lows in, and we're heading up to wave 3, which is going to take us well above 80,000. Okay. I mean, this is just, we don't trade on emotion. We trade on systems and structures, right? And that's kind of how that's how I'm looking at. That's exactly what I'm looking at right here. So does that mean I've been trying to catch shorts along the way? No, not at all. So let's talk about something real quick here. We had a good rally just recently on the 15-minute. We had this good rally right here, right? You should have been playing. You should have definitely played this breakout here for a rally at least up to this liquidity up here. Okay. You should have locked that in as a long there. More likely, you should have actually gone in down here. Right? We're up to there. Now, this is stuff I teach every week over there at the Trading Academy, but that was the trade right there. Okay. Now, once you got there, well, now we need to see what happens, because it looks kind of nice, but you're going to need a breakout higher. You're going to need another push higher. We didn't get it. Instead, we broke down. And in the breakdown, we didn't even get caught in any of the fair value gaps here. Ultimately, it did hit them, but it just bounced and it kept lower. So there was no reason to go long after that, right? So you make a little money there on that long. It doesn't continue any further. Okay, you've locked in profit. No reason to go long again yet. We look down to our next target, right? And so that gets us, again, this morning, we had another good push here off the news, right? Off the NFP release, initial. Now, remember, you usually get knee-jerk reactions off news events. I talk about this all the time, right? It's just a knee-jerk reaction off the news event, letting into this drop here now. Okay? Now, what we're waiting to see here is, does this just become a throw under of this wedge? Right? It's not the greatest wedge, but it is potentially a wedge. It is consolidation, potential throw under. If we can get a nice strong rally back up in here, for me, I start watching now. If we get an impulsive rally back and close back up in here, because what happens? If you're looking at wedges, or, you might call them, ending diagonals or leading diagonals or whatever, usually what you're going to have is a sharp drop. Once it's complete, you'll have a sharp move in the other direction, right? In this case, especially when you throw under a wedge, if it's a legit wedge, usually you're going to have a strong rally back up into it through the top here, and you're going to rally back up to where all the overlap is happening. So for me, I'm watching right here. Do we get an impulsive rally back up here? Because guess what, folks? 4 hour just reset and oversold. RSI did. Stoke RSI is an oversold, right? You've got this higher lows and lower lows here, price, giving us a potential kind of bullish divergence look to it here. But you need follow through with it, right? The other thing I look for is when we have a downtrend like this and it's been in progress, if we all of a sudden at the end have a large spike of volume, that's most often capitulative volume. Okay? That's capitulative volume. And that often will indicate the low of the pullback, like a reversal point. Now, nothing is guaranteed. These are indicators and signals that I look at to start paying attention, right? So what do I want to see now? I want to see an impulsive break out and close back into the range here. And if we can get follow through and an impulsive breakout and close above the top of this wedge, I would look for a target up here at this 59,000 to 59,700, 800 area here, right? Get into that hourly pivot. That would be my target area on that breakout. If we can get an impulsive breakout and close above the hourly pivot, I'm sorry, above this daily pivot. I think this was hourly pivot. No, it is hourly. Yeah. Sorry. Impulsive breakout and close above this hourly pivot. To me, this low is very likely in, even though we haven't broken out above that wave B yet, and we're heading up. We're heading up. And so, this happening when, that greed indicator, the fear and greed indicator is so low as extreme fear, again, doesn't guarantee that would happen, but it means you should be watching for it, right? You have to learn what the indicators are, what the things that are happening that often lead to price doing a thing. And when those things happen, then you need to go ahead and pay attention, right? Because that's the goal of trading. The goal of trading is always looking for that setup. If you think trading is about opening the chart and jumping in right away, stop trading, get out of the market. You're going to waste your money. You're going to get caught left and right. It's a very emotional thing. Trading is a lot more about actually opening the chart and looking for a setup. Looking for some particular price action to happen, right? So when you look at something like ICT or CRT or all these other, names that give you all these price action things out there, right? What you'll notice is a lot of the structures, the setups that they use really are just simple Elliott wave or Wyckoff setups. Now, they probably don't realize that, but it is. There's nothing new under the sun as far as trading goes, guys. Everything is a rehash of something a slightly different take on something that's already been around. And this again is why I continue to teach what I teach. We teach Elliott wave and Wyckoff and even price action. We teach them properly because they're tools to help you understand how and why the market moves like it does, right? How to forecast where things are potentially going, how to look for the setups and create setups that make sense, how to properly place stop losses, right? So a lot of people get out there and they don't know how to place stop losses, and they'll say, oh, stop loss are bad. Don't ever place stop losses. They just lose you money. No, stop losses are out there to tell you when you're wrong, right? A stop loss, when you hit your stop loss, it should be telling you that what you thought was going to happen isn't going to happen. As a secondary result, it saves you from losing a lot of money, right? But everybody teaches stop losses as this way to save your money, right? But that's not the reality of it. The stop loss should be there to tell you that once you go past that point, what you thought was going to happen is not likely happening. That's why your stop loss there. And when you understand that, you can start applying stop losses more properly, right? If you're the type of person who gets out there and you put stop losses in, you're constantly getting hit by stop losses, right? Especially if pretty soon afterward, price turns around and it goes the other way, it goes toward where you were looking for it to initially go. Well, all that tells you is not that stop losses are bad or they don't work. It just tells you that you haven't learned how to place them properly yet, which means you still don't understand structure and you still are having trouble understanding what the market is doing and where it's doing it, right? That doesn't mean, that you're not going to get stopped out. You're still going to get stopped out. It is inevitable that you will lose money as a trader. There's no two ways about that. You're going to lose money. There is no special way to trade. There is no special person out there that can keep you from ever losing money. Don't be the idiot that says, oh, well, it didn't hit my target and I'm down, $20,000 right now, but I haven't lost anything until I exit my trade. That's stupid. It's the stupidest thing, right? Because you could be holding on for a lot longer time. Now, if you're holding on for a long time because that's your plan, right? Because let's say you're buying Bitcoin for 5 years and price comes against you, that, it is what it is, right? You're in your longer term structure there. But if you're trading to make money today and it doesn't hit your target in your trading spot, and it goes down lower, below, where your entry is, and it keeps going, you don't have a stop loss. And you're like, oh, well, yeah, I'm down a few $1,000s, but I'm not a loser. I don't lose it until I actually close it out. So I haven't lost anything yet. Well, what you lost was you lost the opportunity. First of all, you may end up losing a lot, right? One of two things may happen. One, whatever you're trading could go to zero. Two, and this happens mostly, is that you're going to continue holding while it continues going lower and it continues going sideways and it doesn't go up. And you're finally going to give up. Emotionally, you've had enough and you're going to give up. And then you're going to exit. And most often that's going to be at the bottom. Okay. And so you're going to take a loss anyway. But more importantly than all that, or maybe in addition to that, is that you missed the opportunity to go the other way. Right. So, if you talk to anybody that's with us at TWC, I do daily updates of 20 plus charts, right? Covering, stocks and futures and in precious metals and, Bitcoin and other cryptos and stuff. And every time I'm doing an update, right, I said, listen, here's what I think we're looking at. Here is the point at which it becomes more likely that it's correct. But if it does this, and then this would be the target, right? And then I say, but if instead it goes through this other level in the other direction, then we're likely heading in that other direction toward this target. Okay? And what does that do for people? Well, what that means is people don't have to, expect me to tell them which way price has to go, which only gives them one direction. It's a logical analysis that says, listen, we are here. If we go above this level, we're likely going here. If instead we go below this level, we're likely going here. What does that do for you as a trader? It gives you opportunities to trade in either direction, regardless of which way it goes, right? There's no opportunity cost that you're losing. Does that make sense? And that's the way you should look at trading. You should always understand, where do you sit? And this is, again, a big reason why once you learn Elliott Wave, for instance, it's such a benefit if you learn it correctly, because it allows you to know definitively that when you go through a specific level, you are definitely wrong. Your count is wrong. And if your count is wrong, you have a different count, right? You look, you go, well, what would the other likely count be? And where are those targets? And then you have targets, right? So you always have, you don't even have to have a directional bias. I mean, you can have one to set up your count, but once you get ready to do that trade, you don't have to have a directional bias. You can say, okay, if we pop through here, there's the target. If we pop down through here, here's the target. Rather than saying price definitely has to go up or definitely has to go down, and then missing the opportunity. Because what happens when you say price definitely has to go up or definitely has to go down? What happens? Exactly what I talked about at the beginning. You don't have a stop loss, right? Price is going against you because you're so thinking it had to go in the other direction, and you're scared to take a loss. So price continues to go against you, and eventually either it goes to zero, or for most people, you end up exiting, and usually around the bottom. And then price goes the other way. And then you get frustrated, you get upset. But you miss the opportunity to get out of the wrong trade and to get into the right trade. Okay? So we've always got, when we're putting out, like I do Bitcoin updates at least 3 times a day for our folks, right? And they always understand what my bigger thought is. And then more locally, what we're looking at as far as what do you need to happen for it to go, and where is it going to go if you do that? Because that's the only way to trade, guys. When you become so blinded by directional bias, it doesn't, there is no other possibility for you, right? So let's talk about this. Let's talk about the bigger picture here. Oops, let me get the daily here, right? So here's the daily. So for those of you that haven't seen yet, this is what I believe we're looking at, okay? I believe we've got a 1 and a 2. We've got a 3, and potentially the 4 is done here, okay? So why do we do this? We do this because if we measure out wave 1 and pull back to wave 2 here, 1618 extension, 76,530, we almost hit that. So we're pretty close to it to say, and the 1.618 extension of wave 1 is generally expected to be our wave 3 initial target. Okay. And so within that, I can count 1, 2, 3, 4, 5 here as well. Okay. So the 3 looks pretty legit. If we take that retracement, that whole wave 3 here, right? We take that whole thing there. And let me just do something here real quick. Let me get this out of the way. And we take that as a wave 4, our initial target generally is always going to be the 38.2 retracement of wave 3. Here we are bouncing right around it, just shy of it. And not only did we bounce just shy of it, but we did on this huge volume. Look at this. Volume's all down throughout this entire range, months and months and months. And then this one candle, huge volume. Large lower wick shows demand is showing up and takes us higher, right? So initially, wave 4 makes sense there. But guess what, folks? Guess what? If we break down below 38.2, it's not an issue. Because generally, our secondary wave 4 target is the 50% retracement area of wave 3. Now, most of the time, it's going to complete around the 38.2. But sometimes it does go down further, and often when it does, it'll reach that 50% area. So 42,856. So even if we get the breakdown here, you won't see me sweating bullets. You won't see me freaking out. You won't see me changing my mind going, oh my God, the top's in now. No, because I have a structure. I have a system. And I understand where price is likely to go if we are to get that breakdown. So I'm okay if we do that. Matter of fact, for me, if we did get this breakdown here, I'm looking for a reason to buy down here. And I'll tell you what, if we were to get this breakdown here, we'll probably get a much larger wick than what we got right here on August 5th. It'll probably just be a quick drop and a rally right back up, strong move back up, if we were to get that, okay? So at that point, we would be that. Now, if we continued to pull down, well, then we go, okay, well, maybe there's something different going on here, right? But along the way here, we have opportunities to trade along the way. Like I showed you earlier on the 15-minute chart there, whether it would have been today or that previous day. But what interests me at the moment here, again, is, of course, we are in the low volume node. We're hitting this daily demand structure here. Remember, locally here, we're almost to the 70.5 retracement. 12-hour RSI has almost reset into oversold. Stochastic RSI has reset and oversold. Daily RSI is nearing oversold. Stochastic RSI is already there. 4-hour has reset and oversold. Remember, potential bullish divergence, capitulation drop maybe coming in there. Stochastic RSI is oversold. 1 hour, again, here we are. Again, capitulation type candles here with the volume. Notice on the 1 hour, notice we have this. Here's what's important. Notice, okay, so we had a bearish engulfing candle here, but the volume wasn't more than that. That's fine, but it's bearish engulfing. But look what happens here. We get this spike of volume on this right here, right? And this candle spread right here is right there around $1,171, right? Something like that with this big volume. Look what happens on the next candle here. Similar volume, pretty close to it, still well above where we were on average. But your candle spread now, instead of being, $1,170 or whatever, was only $670 or whatever, right? So basically, just more than 50% of what this was, but the volume was almost the same. Again, this is what you want This is what you want to pay attention to when you've got the downtrends or even the uptrends, right? You're seeing similar effort, significantly less result. Now, that does not guarantee it has to reverse from there, but if you're seeing that sort of thing, you should be looking for the possibility of a bounce or a reversal. So we want to pay attention in this area. What's going on in here? You can see that the current candle right now, obviously a much smaller candle. I think it just barely swept the low there. Let me see, 53,845.09, 53, nope, not quite, 53,850. So $5 above this swing low. Volume is well less than half. We've still got about another 15 minutes left. So we'll see how it plays out. But you see how this candle is after you had these two candles? Potential bottoming for a bounce, if not a reversal, happening here. So again, the things you want to watch. Does that make sense? So we're going to watch this. I see a comment. Simano, I hope I didn't screw that up, says, I'm tired of this bull run. Yeah. And that's, that's that sentiment we saw earlier, right? That extreme fear. People are just tired, right? If we look at Bitcoin transactions, something I talked about on Gary's show yesterday on Cardone Corner, they're down something like the lowest point they've been in the last 3 years or something like that. There's disinterest, right? So those that are still in the market are just extremely fearful right now, right? Fear and greed indicator shows that. Those, but a lot of people have left the market for right now. They're disinterested. They're completely just like, I'm tired of this. We're just going sideways. We're not doing anything. I'm out. And those are the types of things that we're looking for when we're looking for a potential bottom in a market. That's what we want to see. Okay. I know you don't want to feel that, but again, there is that quote, you got to buy blood in the streets, right? You got to buy when there's blood in the street, especially when it's your blood, right? What we're talking about is that point. The markets don't get started on a decline, right? So if you're in a decline and that you're, as you're getting into that decline or that sideways, kind of slightly lower highs and lows like we've been for 5 months, right? When you're doing that, and now toward these lows here, which it's not even at the low here, it's on the pullback toward that low. When you see the sentiment, the negative sentiment, increase exponentially like it's been doing, that's usually a sign that you're getting, the bottom in there, that bottom's in there. Okay. Because we're still in this range coming off that all-time high. Now, yes, it is a bearish market structure. Yes, it is lower highs and lower lows. I've mentioned it so many times on here. Yes. But just because it's that doesn't mean it needs to continue that way, right? It's not always going to continue that way, right? Markets move up and down along the way. So your goal as a trader should be to look for reasons where it might be changing, where that price action, the way in which it's printing, might be changing. And so we look for these types of things, right? But let me show you the only thing you really, really, really need to watch, guys. All right. This is a range here. I believe this is reaccumulation, and this is a spring. Okay. It's a very heavy spring. The volume is much more significant than what we had at the initial drop here, or this drop here, or this drop here. What does that mean? That means what we look for is a pullback printing a higher low on a lot less volume. So if we can get a reversal here that carries us, again, daily, impulsive breakout and close above that daily pivot, and this pullback has volume way down here compared to this here, that's a successful test. And you should be long heading up to a new all-time high. So honestly, at this point here, guys, that's the biggest thing I'm looking for. And that's all you really need to look for here. And as far as where do we pull back? Well, again, 70.5 is right there on this. This is the Bitcoin all-time index. So it's a 70.5 retracement of this rally here. 53,495. 78.6 is at 52,301. We have the EQ of this daily demand structure here right around 51,649. And then, of course, we could get a deep pullback, S1 pivot here on the daily, right there around 52.75. Any of those targets be perfectly fine, but what we're looking for is a lot less volume than what we had here. Because what does that tell us? That tells us we had a strong drop, a lot of supply coming in, pushing us down, right? A lot of interest, which got eaten up immediately by demand. When supply gets another chance, they're lackluster. It was like this was their throw here. This was their one chance. And they got eaten right back up, broke out higher. Here we go for a pullback. They're not even trying. They're not even trying right now. Thank God people don't take a drink every time the word if is mentioned. Now, see, now I'll be honest with you guys. One of the worst things, if you're in the markets, one of the worst things you can say, and one of the things that shows, that you don't have a lot of understanding about markets is when you say something like, oh, we could go up or we could go down, and nobody has a clue which way. Well, yeah, we can always go because there are no guarantees. At every single point that price is at, we can go up or we can go down. Nobody can guarantee you, like legit guarantee you, that price is going to go up or down. Does that make sense? Yeah. So that's the important thing to get, right? And so what I mean is, and I'm not necessarily hitting you here. Wits, is it? Yeah, I'm not necessarily like knocking you here. What I'm saying is a lot of people, when they come into markets and they don't understand what's going on, that's what they say, but they mean it very derogatorily, right? They mean it like, oh, well, there's no way to understand what could happen. Well, no, that's completely wrong. At every point in time, price can go up or it can go down. But there are things that if you learn markets and trading and whatever properly, there are things like some of the things I've been teaching you guys here today that you look for that may signal that a thing is happening. When you understand structures in terms of either market structure, bearish or bullish, if you understand Wyckoff structure, if you understand Elliott wave structure, well, that starts giving meaning and an understanding to the way in which price moves. Then you understand it's not actually random, right? Markets don't move randomly because they're human beings in there, and algorithms are based on what human beings tend to do, more or less. I mean, I'm being really, really, really simple with my explanation. Here's what I'm trying to say. But the first clue, is that price at any point in time can go up or it can go down. And the person that guarantees you that price is going to do A or B, don't follow somebody like that, right? Because the worst thing you can do as a new trader, is to come in and you follow somebody like maybe me or somebody else online, right? And when you come in, we happen to get it right. And then you think, oh my God, they know what they're doing. I'm going to just blindly follow them all the time. And what happens most of the time is you end up getting wrecked, right? Because you don't know enough about understanding proper risk management or understanding how they're looking at it. That's why I go through such great lengths when I'm over here on Fridays with you guys to really explain it to you. And it turns some people off because they just want to know, where is it going, and give me a target. But as I'm explaining to you, if that's all you're doing, you're going to lose most of your money, no matter how often that person can be correct, because they're not going to be correct all the time. And if you don't understand proper risk management and use it properly, if you don't understand the way in which they're looking at the charts and why they think these things, you're going to get wrecked. Period. End of sentence. It just takes one bad trade, guys. Okay. So this is the important thing to understand, right? So once you get through that as a trader, once you learn the simple, the simple, truth, which is that price can go up or down at any point in time, then you go, okay, that's true. There are no guarantees. That's true. So number one, I have to learn proper risk management. Absolutely. It's the most important thing you're going to do day in and day out as a trader. And you have to be consistent with it. It takes one bad trade, just one, Completely wipe you out. The second thing that you then learn is, okay, well, now I have to figure out, are markets random or is there a rhyme and reason to the way in which they move? And I'm going to help you out with, I'm going to tell you there is a rhyme and a reason to the way in which price moves. Does that mean you're going to get it right 100% of the time? No. Again, which is why we go back to number one, which is where proper risk management is the most important thing you do. Okay? You have to do that, guys. You have to get to that point. Okay? Shorter term price action is always going to be, the shorter the price action is always going to be more difficult to figure out than the larger term price action because you have more noise. Noise is the up and down fluctuations in price. Okay? So, first part is to recognize and embrace the understanding that price at any point in time can go up or down, because then that forces you then to do number two, which is learn, understand, and consistently apply proper risk management. Then you start talking about, okay, well, is the market random or not? And as I show you constantly, especially, as we kind of zoom out here, right? It is not random. It's measurable. It's forecastable. I hate the word prediction. Prediction, forecast means you're using experience and understanding, to say that price may do this or that. Predicting is just like guessing, basically, right? There's no real, it's more emotion based. So I don't like using predicting. So forecastable sounds weird when I say it, but that's what we're kind of looking at, okay? So again, structure lets you know where you can trade and where you probably shouldn't be trading. Structure lets you know, what time frame you should be looking at, depending on who you are as a trader or investor, because everybody's different. The things that make me the trader and investor I am is different than every one of y'all out there. We got almost 600 people watching right now, different than, probably exactly 100% different than all the rest of y'all, all of y'all out there, right? Because you have to ask yourself, and you have to be honest with yourself, what is your current financial position? What is your current wealth position? What are your short, mid, and long-term financial and wealth goals? Okay? That's just the beginning. Once you do that, then you have to figure out, am I risk tolerant or am I risk adverse? And this is where a lot of traders lie to themselves. You cannot lie to yourself about this, though. You have to know, you have to understand your risk tolerance. Me, I'm more risk adverse. Okay? I'm not extremely risk tolerant. So for me to come into crypto back in 2017 from Forex and from equities and futures and all that prior to that, just coming into crypto, especially in 2017, was a lot more risk than I'm used to. Okay? But understanding whether you're risk adverse or risk tolerant and just how much so is going to help you understand how you should trade. So once you get those things figured out, these are not things you're going to answer in 5 minutes, guys. If you do, you really probably lying to yourself. This takes a lot of real thought. Once you figure out, you have to go, okay, well, how much time do I have to trade? If you're working 8 or 10 hours a day, you do not have 10 hours a day to trade. I'm going to tell you right now, you don't. Those of you that think you can do the day trading while you're sitting at work and just kind of pull out your phone real quick and do something, you're going to lose money. You're going to lose a lot of money. You need to be focused when you're in the market, when you're trading. Okay? You have to be focused. So not only do you have to figure out, well, how much time do I have? How much time do I want to spend trading? If you only have 2 hours a day, Monday through Friday to trade, say from, 7 p.m. to 9 p.m. If that's all you have to trade, doesn't matter that you want to trade more. That's all you have to trade. Okay? So you have to make sure that you're honest with yourself about that. Or maybe you have 10 hours a day that you can trade, but you only want to trade 3 hours. You only want to trade 1 hour. Well, that's important to understand. Just because you have 10 hours a day to trade doesn't mean you have to spend 10 hours a day to trade. And here's why I say this, because the crypto market's open 24/7, and most of the market participants are trying to trade all day and night, 7 days a week. They don't take a break. And those same people are losing money consistently. And there's a reason for that. You have to take a break. Treat trading like a business. Set hours to trade. That's it. It doesn't mean you can't trade on a Saturday or Sunday, but set your hours. Don't just be like, well, waking up Saturday and I'm just going to sit in front of the charts, from 7 a.m. in the morning till 3 a.m. Sunday morning. Don't do that. You have to get the rest. You have to get the pull away from it, because while you're in the markets and price action's moving and you're sitting on Twitter or other social media and watching everybody freak out, or, really excitedly or really depressively, that all builds up in the back of your head. It builds stress. And that stress is going to make you emotional. And emotions in trading lose you money. Period, end of sentence, full stop. No cap. I don't know what that means, but it seems what the kids are saying these days. Hopefully you guys are laughing at that. But seriously, you cannot sit here 24/7 trying to stare at the charts and trade and think you're going to get anywhere. You are going to get emotional as hell. You have to pull away. You have to relax. You have to get your mind off the trading, do something else. It could be work. It could be a hobby. It could just be sleeping, resting. You have to do something else, get away from it, because that releases that stress that's going on in the back of your head. And what that means is when you come back, you're going to be a lot more relaxed. You're not going to be emotional, or at least not as emotional as you would have been had you been doing that. Okay? The fact that I said no cap but forgot Harry Potter's name the other day is amazing. I almost asked you what was his name just now. Oh, man. Jules, what's going on? It says Chris's session is my pep talk session, a much needed one. I'm glad. That's the goal here, right? The goal is to give you guys the reality. Everybody else out there just about is trying to blow smoke up your rear end, right? Everybody else out there is trying to get you to just at all costs to buy whatever they're selling. Do I think you should join TWC? Sure. Do we have different things you can join in? Sure. Different price levels, different. And it's because I believe in what we do, right? So it's a big extension of what I do right here. But at the end of the day, whether you join or not, if you're here, I take it seriously. And I hope to leave you with some sort of knowledge, some sort of understanding of markets that helps you battle against all the other nonsense, all the other grabs for your emotion that are going on out there in social media. Because that's what most of it is. Because that's what it is, right? It's about attention. Guys, I struggle so much with social media. I'll be honest with you, most of the time I hate tweeting. I hate posting, whatever you call it. It drives me nuts. I'm not the type of person to be out there that likes to talk constantly. It doesn't seem like it because I do these shows and do all this. Unfortunately, this is the side of the business that I have to do. And those of you who've been following me for years, I've only wrapped it up in the last, year and a half, 2 years. Prior to that, it was very, very limited. But only because at the end of the day, I have to do it. I promise you right now, if I didn't have to, I would not have any social media. I don't know. I might do a video here or there for you guys on YouTube, but I would not have anything else. It's tough. So for me, it's tough. It's not that I'm an introvert. I enjoy people in general. But I just feeling like I have to be, like I have to force myself to say something constantly is very stressful. It's a lot of work for me. But I do it because, again, it's the requirement of the job there. Schoolboy, have a great day. Jill says, yeah, Scott mentioned how he had to beg you to be his tutor. Yeah, that was right there at the beginning, right? Yeah. We had a little bit back and forth back in the day to begin with. But it's just one of those things, right? We do what we have to do. I'm not on social media to be an influencer per se. I understand that I need eyeballs. because, you know, we do offer a service, we do offer products, and we got to have eyeballs. You know, so I take one for the team for you guys out here. So you're welcome for that. I appreciate you guys, man. You guys are great. I appreciate you saying nice things. Jojo, what's going on there? Guns up, Jared. Guns up. Suns up, guns up. That's right. Texas Tech. But yeah, so I mean, so just so you guys get an understanding here, because I recognize that I do get new people following in every once in a while. You know, and you know, this is what it is, you know, and you may not understand it if you haven't watched me for a few years. Every once in a while, I'll get somebody new in. They'll say, "Oh, you're just a grifter or something." You know, people tend to say that because they can, right? But the goal is to help you understand that I'm trying to hopefully impart some knowledge on you while you're here for however long that you stick around. Something that will help you. Nothing I tell you here is going to instantly change your life as a trader, but they're bits and pieces that if you really kind of digest them and really take them to heart, they will help you on your way to being a successful trader. It's not that you can't be, but most people tend to keep themselves from being successful when it comes to trading. Remember, if you continue to do the things everybody else is doing, you're going to get the results everybody else gets. And we know that 90+% of traders, 97% of traders are out of the market, you know, 3 years down the road, having lost money the entire time. Only 3% actually make it beyond 3 years and actually start making money. So you have to think more in terms of what they're doing versus in terms of what everybody else is doing, which is what you see parroted all over social media, what you see all over the free information that you find online. So yeah, you got to look beyond that. But anyway, so yeah, so here we are. Again, on Bitcoin, kind of look at this area, right? Let's talk about the dollar here real quick. So the dollar, again, I think this is a 1-2, but it could be an AB, okay? We don't have to know which one this is. If it's ABC or 1, 2, 3, 4, 5, okay? Right now, if it's going down, it's going to be one or the other. So if we look at, if this is A and this is a flat as a B, we're coming down. Well, the 100% extension of this first wave is at 93.97. The 123.6 extension is at 91.12. That's our initial target area. Because if this is a wave C, most often that 100 to 123.6 retracement, or I'm sorry, extension of the first wave is where the third wave will go. The C wave will go. If we continue to break on down through there, then we start looking at it again more like a 1, 2, 3. And in that case, wave 3 would have a minimum expected target down here at 86.785. Right down there. And that's it. And it really, trading can be that simple. If you're trying to understand, well, where are things headed? Where's the dollar ultimately headed? Because you know that a weaker dollar means your assets cost more, right? If your dollar's weakened, you know, if you're in the US and your dollar weak, whatever your fiat is, right? Asset prices are going to increase. Everything else held the same. Everything else held equal. Because if the dollar weakens, that means it takes more dollars to buy the same thing. So we're looking at this kind of diamond pattern here. We broke down through it, looking to find a rejection here, you know, around this weekly pivot if we make it up that high, and continuation down lower. Weakening dollar means equities, Bitcoin, stuff like that should generally rally in price. Now, again, that's all else things held equal. Now, there are other things that can happen along the way that'll fluctuate that a bit, where things may not move exactly the same or may move a little bit differently. But all else held equal, if the value of your currency is dropping, then the prices of your assets are going to rise in relation to that, because it's going to cost more of that currency to buy those things. All right, guys? So ultimately, looking for us to come down. Now, those of you that haven't been following me, you don't know. But when we were back down around here, this was January of 21, I mentioned that this was likely going to be the bottom and that we had 114 to 115 target. Of course, it went up here to 114.745. Now, I mentioned that down here, but we still needed confirmations, right? The rally up, we got a pull back here, we got confirmation. That's great. But the important thing is we noted it down here with this target up here, and then over the next, and by the way, I did that live on this show, as a matter of fact. And then for 630 days, it took it to reach that target. So, you know, just under a couple of years there. That was September of 22. And once here, I said our initial target is 100, right? And we dipped right around that area. But what we've done is just kind of gone sideways since then. But again, now it does appear to be breaking down lower here. As a matter of fact, did we get below this swing low? 100.32, 100.4. No, we're still slightly above this previous swing low here. Now, I expect this, like I said, a 1, 2, 3 or an ABC, but we still need some confirmation further down, right? We need the breakdown, at least the first confirmation is the breakdown below this swing low. All right. Now, what I can say here is this does appear to be 3 waves up, which would be corrective. So again, breaking down below that, well, we broke down below here, which should then indicate, you know, that this is corrective and we're heading down lower. But we definitely, of course, want to continue to see breakdown below that 99.22 low here to really kind of add some confirmation to that. Where do you think the price is going to go for the dollar? That's what I was talking about, Revy. If this is an A, a B, and a C, you know, and this is a C coming in, we would look for this range, this 91.12 to 93.97 range. If we continue pushing on down through that, that's going to suggest, it doesn't guarantee, but it's going to suggest this is a 1, 2, and a 3, and that'll give us an initial target around 86.795 on that right there. Okay? So that's what, you know, that's where I'm looking at ultimately as far as we go on all that. Now, that changes if we're breaking out above this swing high up here. This 106.38. If we're going above that, that means we're probably going above that swing high. Doesn't mean that we won't eventually come on down here, but now at that point, we start looking up here toward, you know, 110, maybe even 113 there. And the odds are, you know, if this is the low here, we're actually going to head up toward about 120. We'll actually be looking up here toward 100, maybe 125 and a half, right? So again, my bias is to the downside, but I've got levels that we need to kind of get through to add more confidence to that. But I also know that if I'm wrong, it's going to be because it breaks up above that swing high right there. Now, that won't say it necessarily has to go up to 125, but it does mean at that point, I'm going to expect that we'll probably break out above here. And if we do that, again, we're looking up here around that 110, 111, and then, you know, maybe 113 as target areas here. And especially if we're getting around that 113, that really opens up the idea that we'll, you know, head up there toward 125. Okay? Does that make sense? So that, you know, again, this is what I was talking about earlier. You know, price can do anything. We don't know for sure. People get out there a day in and day out, and they will guarantee you that price is going to do this thing. And sometimes they'll be right. And they'll say, see, I guaranteed it happened. But they're going to guarantee a lot of times it's going to be wrong. Okay? You got to be careful out there with that. So I would never trust anybody that guarantees you that price will do a thing. When we were down here, I didn't guarantee it was going to go up here because I don't have control over the market. I can't make it do. I could have misread something here. But I said, I gave you my reasons at this point here. Those of you that were here remember that, right? I said, first of all, usually you'll get your reversals with your currencies most often in the first month of the year in January. And if that was January. Also at the time, we were talking about how far off sides sellers and buyers were. It was something like 94% were biased to the downside. And when the market, and at the time I told you guys, when the market, when you're that off sides in a market, the market tends to correct you. It doesn't allow you to remain that off sides. It wants to bring back more toward balance, right? And that's what it did. And then even then, I said, even with all that, and here's our target, I said, we still want confirmation. And we got a good bit of confirmation when we did 5 waves up here and then 3 waves back and then broke back out above that third wave there, right around 91. What is that? 91.435. Because that said there's a 1, there's a 2, we're heading up. Still didn't guarantee we're going to get 114, 115, but you have to have targets. You have to have understandings and whys, right? Let me see here. What'd you say here, Revi? Another curiosity I have, isn't that diamond pattern bullish given it's forming after a drawdown? No, diamond patterns are not bullish or bearish, typically, right? It's not like most of the time it's bullish or most of the time it's bearish. They're just a consolidation into expansion into consolidation again. And so, at that point, you just kind of look for, do you get the breakdown through support or do you get the breakout through resistance? So for me, the fact that we got a breakdown through support adds some confidence to the idea we're to break down further, but it does not guarantee it, which is why we watch these other things, right? Yeah. So for instance, if we see on the weekly an impulsive breakout and close above that weekly pivot, that's going to give me a quicker warning that we may be breaking out above this swing high up here. And so I'm going to pay more attention to it. I'm going to zoom into a smaller time frame. I'm going to start counting waves on that smaller time frame to see what we're going. Jules, have a great day. What's going on, Mike? Troy, have you ever heard of the macro analyst David Hunter? He has a pretty interesting view on impending deflation bust, and you're the only other person I've heard use that phrase. I may have maybe seen him sometime. I don't, off the top of my head, I can't recall him, but let me write this down and I'll check. I do have plans to start getting more regularly, to start getting people in here on the weeks that Fibbo's not here for like the first 30 minutes of the show or whatever to interview. So I love the suggestion. If you guys have any other suggestions, leave them for me below the video, whether it's on, probably the easiest way is on X or on YouTube here. By the way, while I got your attention for a moment, guys, hit the like, subscribe to the channel, follow me, leave a comment. I appreciate it. It helps the algorithm, right? It's not me. I'm not that into myself, whatever the word is. But it does help the algorithm so other people can potentially find, the content that I've got here. So if you like it and you think that other people would benefit from it, do me a favor and do that, okay? Let me see here. Yeah, so kind of that's what I'm looking at here. Yeah, Revi says, was living with the idea that a diamond pattern is a reversal if it's coming after an uptrend or downtrend. Yeah, and that makes a lot of sense. And sometimes it does. But I haven't seen any real statistical confirmations that that's what's going on. It seems a lot more iffy, a lot more 50-50 kind of idea. And so when it's that iffy, I just technically, I just look for either a breakdown through the support or a breakup through the resistance. As my first clue that maybe it's going in that direction or the other direction. Okay. Let me see here. See, Andrew says, yes, enjoying TWC. Andrew was one of those guys. I love Andrew because he's one of those guys that followed me for like a while and then finally jumped in. And man, oh man, his growth as a trader has been absolutely amazing because he posts all the time. So, it's not just my charts that are in there, but you got people like Andrew and Sats and others that are in there that are, posting their charts as well. But Andrew's been absolutely fantastic. I love watching him grow as a trader. It helps me out because sometimes he sees things that I don't in some charts, because there's only so many charts I can look at. He's like, hey, Chris, what do you think about this, man? I'm like, oh, I like that. So, yeah. Let me see here. Let me jump here real quick. I want to talk about oil here real quick, guys. So oil is something I kind of touched on yesterday with Gary Cardone, okay, and on his show yesterday. And I had been, as we kind of came down here, the count, it's really kind of a lot of overlapping price action here, and we kind of found some support right in this previous resistance. And so I was looking at the possibility that maybe we break 100, right? But now, we didn't get that though, right? We stopped here. This is the weekly chart. We stopped here at 95. And it looks like it's potentially a 1, 2, 3, 4, 5, right? So it looks like it's potentially a wave B. And then we, again, kind of like with the DXY, that diamond support. So this support right here, we're getting an impulsive breakdown through this. This is significant right here. All right. Let me see. Let me put some pivots on here real quick. And oh, I don't have any volume on here. You know what I'm going to do? I'm going to do this real quick and throw my volume on here. And everything else I usually have on. And so this is interesting because now we're talking, if this is an A and a B, then we're talking kind of like with DXY, oil price, targeting $39 to $46. This starts getting interesting. Because again, if you're thinking about oil, right? If the price of oil is coming down, that means things in general should be cheaper for you. Why is that? Because when people think of oil, they often just think about the what do you call it? They're thinking about the transportation. Sorry, brain stopped there. Thinking about transportation, right? And yeah, there's a lot of oil, in transportation, especially when you think about, airlines and cruise ships, right? But here's the thing. The oil is a lot more than that, right? Oil is used in petroleum. Petroleum is used to create plastics. Our world is nothing but plastics these days. For better, worse, or otherwise, everything is plastic. So if the price of oil is dropping, that should make things, again, everything else held equal, should make things cheaper. Now, also, you have to take into understanding that when oil is cheap like it is now, really it's just the bigger players that can profitably pump that oil. Okay. So what happens is these bigger players will probably, try and find ways to pump oil cheaper. But what it means is the smaller players are going to be pushed out. Yeah, those that haven't already been pushed out. It's kind of like if you think about, Bitcoin and Bitcoin mining, right? When the halving comes in, the rewards are less, right? And because the rewards are less, and mining is such a capital intensive thing, much like oil production, the smaller players go out of business, get taken over, merged into, those things happen. But looking at this weekly is starting to look quite interesting as far as a potential move down toward $39 to $46 for oil. So, again, bigger pictures, just zooming out, things are looking kind of interesting there. I'll talk about Bitcoin here, small time frame. What we got going here on the 15-minute? Well, what do I like about the 15-minute here? I like that we have bullish divergence at that swing low. Let's see here, current interval only. We have a hammer candle, also called a pin bar, large lower wick there. We have a nice big candle following it up, and we're continuing to follow up here. I like these things. How far have we rallied off that swing low so far? Up almost 700 bucks. That's all right. Let's zoom in a little bit here, because we're running into resistance right here. So if we look at the volume on these two candles, you'll notice, well, this one now is starting to push a little bit more volume because you're running into the supply right here in this order block right here. Okay. But taking that out, things start getting interesting again. Zoom out to the 1 hour. 1 hour, we dip down and oversold, rallying back out, working toward a bullish cross. Stoke RSI threatening to cross bullishly, and then we'll look for a breakout of oversold. Again, pin bar candle. In this case, it's a doji. Nice longer lower wick there. Remember, the lead up to this was these two candles right here. Their volume price action that I explained earlier. Look what happened on the next one. A little bit more than half the volume, but now it closed higher than where it opened. So supply completely lost out on this one. So effort versus results changed significantly within those three candles. Here we go, pushing up. 4 hour, again, reset and oversold. I like that. Reset and oversold here. Looking for a cross out, bullish cross. 12 hour has not reset and oversold on the Stoke RSI yet, so iffy on that, we'll see. But man, oh man, if we can hold support here, say on the 12 hour, on this S1 pivot, or on the 4 hour, if we can close back up, the more of this 4 hour candle that we overcome in this current candle, so the next 2 hours and 34 minutes, the stronger the likelihood we're getting a reversal off this bottom. Again, not guaranteed, but one of the things we look for as we look to kind of build our narrative based on price action, not narrative based on economic news or emotions or anything like that, just based on price action, right? Let me see here. So let me see here. If we jump here, let me jump back at 30 minutes. That's what I wanted to look at. So this 30-minute also looks pretty nice as well. Look at, again, notice the volume change here on the movement into these three candles. So we had this big volume here, and we had even more volume in this little tiny doji. So the body compared to this big body, right? And then we got a little bit less volume and a little bit bigger body. And then what happens? Lesser volume, smaller body, lesser volume, small doji, closed above where it opened. And then we start picking up some volume at the low here again. Doji, and then here we are pulling up. This looks like a nice rounding bottom here. Let's see some follow through up higher. If we can, basically what we want to do is we want to see this move, a nice strong move back up into this descending wedge. And then after that, the next step that we'd want to see that would continue to add confidence to this idea that maybe the bottom may be in is we want to see an impulsive breakout and close above the wedge resistance. You can look for it on the hourly. Whoops. You can look for it on the hourly. If you can get that, again, you should be targeting up here around 59. It says 59.80 on this chart to the hourly pivot there at 59,696. Next step would be an impulsive breakout and close above that. If you do that, going to add more confidence to what we're looking at and suggest we're probably going to come up here toward the top at around 64,270. That'll take us above this wave B, the third wave, which should then say that wave 2 is complete here, right around the 70.5 retracement, and we're heading up for wave 3 up into the upper 80s there. So that's what we're kind of looking at there. All right. So, again, before you get all bent out of shape, by the emotional things that people are saying out there on, on social media and whatever, go back through this video, this session, this episode, whatever you want to call it. Look at the things I told you that, that we generally look at and why and how to read them. It's a start. It'll get you started. Now, obviously, again, we teach a lot more at the Trading Academy. And, we would love to have you join us. You can do so underneath this video if you'd like to do so. But the one thing I can tell you is if you do come in and you really put forth the effort, in a year, if you take, we've got 3 months, 6 months, and a year that you can be in the group coaching. But especially if you go for the year, you'll be completely changed as a trader. You're going to understand things when you look at charts that right now you have no clue. And that's the great thing about it. And of course, you get to the understanding that you're not mystical. You're not a wizard. You don't have a crystal ball. You learn the importance of risk management, how to do it properly and to be consistent with it. You learn something that most people don't teach you, which is how do you approach the markets at times? Like a lot of guys, they'll say, okay, yeah, we're going to enter here and exit here. But what you want to understand is how do you approach the market depending on the structure? Is it even worth getting involved at that time? And I spend a lot of time discussing that each week as well. So anyway, there we go, guys. So that's where I'm at. I need to get out of here. It's 12:30 now. I didn't mean to spend so much time teaching. I actually meant to go over a lot of charts, but hopefully you got a lot out of the teaching. Again, the things I say here won't turn you into a profitable trader overnight. But if you really listen to them and you take them to heart and you kind of internalize them, they are definitely going to help you be a better trader. You'll take less bad trades, which means you have less money to recoup before you can make money. And then, of course, the trades that you do take will be a lot more likely to actually pan out for you. And that's the way to go, right? So I'm going to jump out of here. Yeah, again, if you want to check us out and things we have there, if you got questions for me about what we do at TWC Trading Academy, let me know. Feel free to, send me a DM on Twitter or ask a question underneath this video on Twitter or even underneath this video here on YouTube. And I'll get back to you as soon as possible, all right? But, whether you join us or not, guys and gals, listen, take it seriously. Take trading seriously. I'm proof that it has the ability to change your life. But you have to get out of the old mindset and the way that everybody comes into trading thinking. All those things that you think and how easy it's going to be, how quick you're going to make money. And you need to start looking at it for what it is, right? It's a skill set that'll pay off. And the longer you're in it, the more time it'll pay off. The more it'll pay off, right? It's not a marathon. You won't get rich overnight. Or it's not a sprint. It's a marathon. You won't get rich overnight. Somebody said it best. They said, think of trading as a business where you're developing a system that's going to make you more and more profitable and reduce your losses the longer you do it. That's the best way to think about trading, all right? All right, guys. As always, remember, the only thing you control is how much you lose. So please keep working on your risk management. I hope you guys have an amazing day, amazing weekend. Trade safe out there. Like I said, hit the like button, follow, subscribe, leave a comment. I will see you guys, geez whiz, I guess next week, right? Don't forget, I do Beards and Bitcoin. Same channel, same time on Wednesdays with Andrew and Tillman. And that one, we usually go beyond price with Bitcoin and talk more about Bitcoin itself and the financial system, TradFi, and how this all interacts and interoperates for y'all. Miners sometimes we talk about as well. All right? Y'all take care.